Why Keynes now? Why Keynes now? Well, two obvious reasons. First of all, none of the currently dominant school of economists could really explain why the banking system had collapsed so spectacularly. Even those who warned that house prices were too high never imagined that the banking system would become so heavily contaminated by housing-based securities. In short, they miss the devastating potential of virtually unregulated securitization. Secondly, policymakers were confronted by the fact that the banking collapse was followed by a more general collapse of asset prices and by a still more general rundown of the economy. Its decline in the last quarter of 2008 being the fastest recorded since the end of the Second World War. Both these real-world happenings, the collapse of the financial system and the collapse of the real economy, blew sky-high the two dominant paradigms of contemporary macroeconomics. And I call them Chicago economics for short, though not all their protagonists actually reside physically in those couple of universities around the Great Lakes. The first paradigm was the efficient market theory, the view that securities are always correctly priced on average. The second was the theory of the self-correcting market, the belief that following a disturbance or shock, wages and prices adjust rapidly to the new equilibrium so that full employment is continuously or almost continuously maintained. It was their instinctive understanding that this was wrong, this view, that led governments the world over to devise and implement stimulus packages to avert a deeper slide into what looked at one time as though it could be a repeat of the Great Depression. First, by bailing out the banks, and second, by direct action to maintain aggregate demand. Now, let me start from the failure of Chicago economics to explain the slump. If financial markets are efficient, then what Greenspan called the underpricing of risk worldwide couldn't have happened. It's characteristic of this class of theories that when things do in fact go wrong, their first response is to blame the government. Because markets are perfect, therefore, if something goes wrong, it can't be the fault of markets, it must be the fault of the government. The trouble was, they say, that we weren't really in a free market. Banks were overregulated. Administrations put pressure on Fannie Mae and Freddie Mac to extend mortgage loans to people who couldn't repay them. And then, of course, there was Alan Greenspan himself, who stoked up the furnace by keeping credit too cheap for too long. So it was all someone else's fault. It's rather like someone who says, well, who blames himself, who blames others for anything that's gone wrong, rather than look at himself. And George Soros hit the nail on the head, I think, when he said the salient feature of the current financial crisis is that it was not manufactured from outside. The crisis was generated by the system itself. That seems to me quite right. Now, to understand why this crisis happened, there's no better guide than Keynes. And I want to extract just two thoughts from his musings on the subject. First, he emphasized the inherent instability of investment markets. Second, and perhaps more fundamentally, he pointed to the inherent weakness in the inducement to invest relative to the propensity to consume, and I'll explain, to save rather, and I'll explain that in a little moment, because the first is easier to grasp. The volatility of investment, Keynes saw as a short-run problem, but the weakness in the inducement to invest he saw as a secular problem, which had been prevalent throughout history, but was amplified in rich societies. And both these features, the volatility of investment and the weakness in the inducement to invest, were related to fundamental uncertainty, the fact that we don't know what the future is going to bring us. In attacking the theory of efficient investment markets, Keynes made a crucial distinction between risk and uncertainty. And until this distinction enters into the craniums of economists, regulators, businessmen, and governments, we're bound to go through the same process again and again. We keep talking about risk and managing risk. It's right there in our vocabulary, the management of risk, when we should be talking about uncertainty and managing uncertainty. The risk management approach is buttressed by mountains of phony maths, which issue in numbers which purport to measure the precise degree of riskiness of any future transaction, as though the universe were like a game of dice. Thus, I read in one investment prospectus that the estimated probability of a 4-year period of negative relative returns from a mathematically based investment strategy is 99.4% over 25 years. Now, so they have a computer into which they plug in hundreds, if not thousands, of variables to which they attach numbers based on fragmentary and incomplete information, which issues in a central estimate of probability down to a decimal point of something happening over 25 years. Yet I ask you, what will be the price of oil in a year's time, or of a 10-year treasury, the 10-year treasury bill rate? If you're honest, you'll say, I don't know, and I don't know. Now, Keynes's starting point was this: the extreme precariousness of the knowledge on which our estimates of prospective yield are based. Nevertheless, he says, the need for action and decision compels us as practical men to do our best to overlook this awkward fact and to behave exactly as we should. I'm quoting, we should, if we had behind us a good Benthamite calculation of prospective advantages and disadvantages multiplied by its appropriate probability, waiting to be summed mathematically. And so for real knowledge, which we lack, we substitute what he called conventions, of which he highlighted 3. And we see how they operate in all our walks of life. The first is that the present will continue into the future. The second is that existing share prices correctly sum up future prospects. And the third, and most basic, is that if enough people believe in something, it must be right. Our expectations, that is, are conventional rather than rational in the way defined by rational expectations theory. Such conventional expectations are compatible, he said, with considerable stability in our affairs, as long as confidence in the convention holds. But they're liable to serious overturn, sudden overturn, when some passing bit of news comes, bad news, let's say, precisely because there's no firm basis of conviction to hold them steady. Then, I quote, the practice of certainty and security suddenly breaks down. New fears and hopes will, without warning, take charge of human conduct. All these pretty, polite techniques suitable for well-paneled boardrooms collapse. And that's exactly what happened last autumn. Everyone was going up a staircase in the dark, and suddenly the next step wasn't there. Because they believed, they knew what was going to happen. They believed they had probabilities about it. Now, I would claim that Keynes's fist at explaining market volatility and its associated herd behavior is better than the currently fashionable behavioral economics, which sees these swings as essentially irrational. Keynes wrote, the market will be subject to waves of optimistic and pessimistic sentiment, which are unreasoning, yet in a sense legitimate, when no solid basis exists for a reasonable calculation. In other words, there's no need to jettison the axiom of rationality which underlies all economic thinking. We just have to abandon the pretense of perfect information. We have to start by asking, what is reasonable behavior in face of an opaque future?